Hi, this is Pat Moorhead with More Insights and Strategy, and we are here for another FinTech and Retail Tech Friday here with Vice President Melody Brew. How are you doing?
Great. Do I seem happy?
You do seem happy, and I don't know if it has anything correlated with the fact that maybe kids started going to school. I don't know if there's a
I
direct or inverse relationship there. I don't know.
I am well, one, I'm happy that we're back at it. It's been a while, and I'll take the blame. You always take the
Are you
blame.
kidding me? I
Um,
totally canceled on you. Well, you know what? That last one, I did show up. I
yeah,
was
the
there.
last one, that's partially why I'm really happy my kids are back, that kids are back in school. But yeah, kids are back in school, and it's been a great week, and we just have a lot to talk about. And
I know we really do. And, we're talking part one of a mid-year review. And hey, we understand it's not the end of June, it's the end of August, but that's okay because not every company is on calendar year. Okay,
yeah,
so give us a break. In fact, I mean, Cisco ended their year last quarter. So, anyways, but we're
yep.
talking crypto, buy now, pay later, and the acronym of the week, BTFD. I can't wait to dive into that. I know what BFD means, but not BTFD. So let's dive in. Let's talk about this. I mean, are we in a crypto winter? Is this thing just done? What's going
I
on here?
well, I don't think it's done. I mean, it's funny as we were in summer when we originally started talking about the mid-year reviews. um, we were in like a full crypto winter. I mean, June was, really when crypto took a dive. I think mid-June was kind of the worst of it. Kind of, if you look at the crypto prices, kind of saw a little bit of a rally there. And then I looked just earlier today, I think Bitcoin was at like 21,000.
Yeah.
But when we talk about, the crypto winter, it's more than just the price of cryptocurrencies. There's just stuff is happening everywhere. And, what the winter was really, like literally these crypto companies were freezing assets, freezing people's cash, billions of dollars in frozen cash. Celcius is one of them. People's money is still tied up there. There were a number of different companies that had literally billions of dollars in people's cash tied up. Babel, Coinflex, Voyager. Voyager, I think, had people's money tied up for like several months. They've now released, I think just a couple of days ago, probably about a week ago, now allowing withdrawals. I mean, so many of these companies just were not allowing withdrawals because they just had liquidity issues. So now many of them have gone into bankruptcy, restructuring. There's just, a lot. There was just a massive exodus from investors in June, and the price has not yet recovered. And I bet when you had your $30,000 floor, I bet you wish you had put the floor a little lower there.
Yeah. By the way, I'm out of everything.
Yeah,
I flushed everything about 2 months ago,
yeah.
but I didn't even do our disclaimer. So
Oh, yeah, right.
didn't even do the disclaimer. This show is for informational and educational purposes only, because you certainly don't want to even think of doing something that I might even infer, because I've lost a ton of money. I did have a company that was bought in my high growth account, and I am basically I'm close to even on the drop, but it took a wild acquisition of a company to get me there. But hey, we're not talking equities here, right? We're talking retail and fintech. Okay.
Yeah. So, are you talking about a company that's in the crypto space, or are you just talking about?
No, no, this is
Oh,
just
okay.
an investment that I had made. I was down, I don't know, 70-80% on my high growth portfolio, which is
Mm,
pretty much where I dumped most of my money for about 18 months. And I
yeah.
got slaughtered, but a drug company got bought. So, but anyway, so
That's good news.
what is the opportunity here? Assets were frozen. So
Yeah.
where do we go from here?
Well, with all of this restructuring happening, there are some places where people are able to get their money out. Those are, I'm not a lawyer, but I've seen a lot of things on Twitter where people have to file certain things by certain times and whatever. I'm going to leave that to the lawyers. But, in addition to that, there's like thousands of people who have lost their jobs. There's trillions of dollars in value lost. But what this is creating here is this sort of switch to one, there's like all of this M&A activity happening.
Yeah.
There's also a lot of failed deals happening. And the reason for a lot of these failed deals is that when they, get to the point of the due diligence, they can't produce audited financials. There's still this kind of like Wild West that's happening in this space that maybe this crypto winter is sort of weeding out the bad and, letting the strong ones survive. And it sucks that, the retail investor has to suffer through that. That part really sucks. But when, you go through a couple of down markets and you survive, then, you see who the strong ones are and who's going to remain. The top talent are going to remain there, and you're going to end up with some really strong companies in the end. So as an investor, some of these companies are coming in and they're, basically consolidating the space. And it's not just about cryptocurrency. A lot of people sort of talk about blockchain and cryptocurrency together. Public blockchain obviously has to be tied to cryptocurrency, but private blockchain doesn't. But there's a lot of really good opportunity here for B2B space, especially in blockchain with payments. It's like the B2B space has a lot less volatility. So like Paystand, which is a B2B payments company that operates sort of a hybrid model on blockchain, they just acquired a company, I think it's called Paydo, and became a unicorn. So think about this, a company that operates in the crypto space and fintech, both that are in like a major down slump right now, just became a unicorn.
That is crazy. That is crazy. Now you put a company called Binance in the show notes. Why did you do that? Are they part of this?
So Binance it's really interesting right now because Binance, they did actually freeze their withdrawals for just like a day. They blamed it on like some transactional issues. But the reason why I put this in is because she's the co-founder. They are really investing in this space because they see the long view. So that's kind of what I'm talking about. They're looking at like Web3, metaverse, B2B stuff. They're looking at, the really saying like, okay, there are some really great deals to be had. There's some really good talent in this space. They can afford to be aggressive right now because they've seen the crypto winter before. They've seen this happen, and the shakeout maybe is a little bit necessary. The other thing is you can see what happens when, and I think we talked about this once before, it's like you can see what happens when people really, like Binance, they focused on their engineers and their product and their employees and keeping people. They're actually hiring right now when others are laying off, a quarter of their workforce. They didn't name a football stadium. You know what I'm saying?
Right.
Like, so they can look at their balance sheet and say, yeah, we can now we can be aggressive in our acquisitions. We don't actually need to lay people off. Right. So I think that some of this is sort of a necessary shakeout in what's going to happen in the space. It's unfortunate that there's a lot of people who are getting hurt in this, but the end product is that you're going to have a stronger crypto ecosystem.
That's a good way to end. So with that, I don't have to worry about crypto anymore personally. Like whatever, I'm going to watch everybody else lose all their money. But no, you're right. I mean, it's more that, the blockchain is very much an industrialized technology, not to be confused with the, cataclysmic drop in some of the consumer investments. And I don't know if you saw, there was a CEO who made a big crypto investment for his company. And I wish I could remember the name of the company. It escapes me right now, but he retired to the board as the company lost billions in it. So hey, let's move to an update on buy now, pay later. Like where are we? We're a little over mid-year. We talked about that, but
Yeah.
What is going on? I mean, is there an impending debt crisis coming up?
I think there is. I think that, if you look at what we know about buy now, pay later, the in general, the industry has seen default rates almost double over the last few quarters. I mean, to back up a bit, people started using it a lot during the pandemic. Online shopping increased a ton. People were using it to buy things like Peloton, finance all of these things. People were also getting government stimulus. Now we are, in a recession, or I guess maybe not a full recession, but we've got high interest rates, inflation. This model has never been really tested, right? Like through any sort of financial crisis. And so now what you're seeing is default rates have almost doubled over the last couple of quarters, where credit card default rates have actually remained flat. So more than half of users have had one late payment. Over 60% of Gen Z has used some form of buy now, pay later. So that means half of 61%, 50% of 61% has been late on a payment.
Bye-bye. I don't like to interrupt, but sometimes I just have to. I'm just going to do a victory lap right now. Listen, and not that I'm happy that there's, plummeting valuations and debt crisis, but it's just like, remember I asked you, I'm like, sounds kind of like a credit card to me.
Yeah.
But it's like, hey, it's credit card without the oversight. That's got to be great. No, you didn't say that. I know that, but seriously, it's just like, I mean, it's just waiting for a downturn, right?
Yep. Absolutely.
So I'm sorry. Carry on.
You are right. And I do remember you talking about that, you saying that, like, why not a credit card? So, the reason why is because there are people who don't have access to traditional financial services or are credit thin, or they're subprime, or they're, just below prime, I don't know, near prime. And these companies allow them to buy things that they need. Well, they went from allowing people to buy things that they need and pay it in installments to now, like we've talked about, pay for, you can buy a Chipotle burrito and pay for it in installments. You can buy gas, you can buy a plane ticket, you can buy so many things. So what started out as just this thing with so much promise has now, and ridiculous valuations. Affirm's share price is down more than 75% from the start of the year. Afterpay is down 60%. Klarna's last valuation was down like 85% from like whatever their last valuation was a year ago. And there still is no regulation around it. And that's the problem. And like I said, the credit card default rates aren't happening at the same rate. So I think probably what that means is that a lot of people are using these buy now, pay later. If that high of a percentage are using it, they're using it instead of a credit card. And so they're defaulting. And so there's just not, there's this, I think, to go back to like, what's the opportunity here? The opportunity is some oversight. And there's really what needs to happen here is some sort of reporting. They need to come together and have some sort of shared database. And one thing that's attractive about this is if you're not approved, it doesn't actually hurt your credit score. And so that's what people like about this, is they can see.
Who doesn't like that? I'm assuming it's at a higher rate though, right?
Well, it depends. So some of them have a 0 rate if you pay it quickly. Some of them have a higher rate. They do a soft check on your credit. But it doesn't go on your credit as a hard check. So if you were to go to like get a mortgage, you've had too many inquiries lately, that number of inquiries that affects your credit score. So, but there needs to be some way that they can actually like ping off each other, because you could go and you could get a loan from Affirm and one from Klarna and one from Afterpay. And then all of a sudden you have 6 to 8 or to 10, however many you can possibly have. They don't know about the other because they're not reporting it to the credit bureaus. And then you're just in over your head. And so it's actually not protecting the consumer, right? So the Consumer Financial Protection Bureau needs to step in. they started an investigation about a year ago, maybe a little longer, and they've done nothing about it. So they really do need to step in and take some control over this. And actually, these buy now, pay later companies are asking for it. They're asking not necessarily for the oversight, but they're asking for the reporting. They want to be part of the system in a positive way. They want to be part of building consumers' credit. I think, some of them have these one-off deals with like Experian, where they report good behavior to Experian. A lot of them will report bad behavior, but they don't have the ability to report good behavior. So,
Yeah.
A lot of the promise of fintech is to bring people into a traditionally non-inclusive financial system. And that was what buy now, pay later was, sort of sold as, right?
I love the marketing
Right.
of that. I'd love to see the demographics of who actually used it. And listen, don't get me wrong. I like that we break a little glass,
Mm-hmm.
and I'm not, joyful because something isn't going well. But this was pretty easy to see in a downturn, and with basically zero interest rates from the Fed, to like the cost of capital for these buy now, pay later companies was essentially zero, or close to it. So here we are, and they didn't even need to make money because they're startups, and they were going for the cash grab, and they were funded by VC companies, so they could charge less interest rates, right? Because they didn't really score credit, too.
Yeah, and really they make their money from the retailer anyway, because the other thing is the psychology of this is that because somebody isn't paying in full for it, even I'm sure even when you pay with your credit card, you do feel like you're paying in full, but for some reason this model makes people spend more money than they would with a credit card or when they're paying cash. So your cart size is larger and your cart abandonment is lower. So retailers love it. So the retailer is actually paying for it. So they're making money on the retailer and the interest rate.
I mean, it's right there. No, by the way, that's a great point. There must be some psychology of it. I've noticed these things pop up in so many of my shopping carts now. And she's like, one little click. Yeah. One little click. My gosh, I think I even remember seeing it on Amazon.
Yeah.
An Amazon cart, or maybe that was a Best Buy cart. I don't know.
Yeah, Amazon actually has, I think, their own version of it. I know they partnered with somebody actually. I should know this, but yeah, I mean, there's almost everything at this point that you can buy, whether it's PayPal, Pay in 4, or some version of buy now, pay later. There's the big players, but almost everything, even the major credit card holders or credit card companies are doing some form of, it's not just your traditional terms that you would have with your credit card, but they have some, no interest if you pay like in these 4 installments or, some arrangement like that. But really, like there has to be something where it can help people to build credit. And I think they're making a move towards that. Hopefully that will happen. But in the meantime, I think where there is a real opportunity where a couple of companies, 2 that stand out, one is called Katapult, the other is called Caffeine. I think that's how you pronounce it, Kafene. They're lease-to-own companies. And they concentrate on kind of the subprime market. But what they're doing and why they're different is that they are actually focusing on things people need. They're not saying like, go ahead, buy that Peloton, buy that, whatever, like these things that aren't necessities. They're saying like your refrigerator broke, you need a refrigerator. That's actually really important. You need a computer for your kid to go to school, whatever these things are. They're more like necessity items. But the more important thing than, making a judgment on whether somebody needs something, whether it's a need or a want, it's a lease to own. So you don't actually own that product. It is not yours. You make payments on it until it's paid in full, and then you own it. But at any point, if you become behind in your payments or it becomes overwhelming for you, you can return it and you're done. So it's not as predatory as a lot of these, where they like, you're just locked in. It's yours. There's nothing you can do about it. And they're going to put this on your credit report and you're screwed for life if you don't do something about it. In fact, I read on the caffeine website, they will actually they will report the good behavior. They will not report the bad behavior. They will try to work with you, and basically they'll, chase you down, not like a debt collector. I mean, it sounds like it, at least, like you said, the marketing is great. I would say I would like to try it out, but I don't want to have, something impact my credit. But, in theory, I like this because if somebody needs to return something and not have that, massive weight on their shoulders of, what do I do now? I don't know how I'm going to pay for this. It's just, I think that it opens up this, something that's a little bit more manageable for people, instead of getting all of these things that are piling up and then that could damage their credit. This is actually a model where they could potentially build good credit, get out of that subprime and build some good credit. So, and I know I've actually spoken to the people at Katapult before. I know they will return anything at any point. It doesn't matter if it's used. It doesn't matter. They will recycle it. They will donate it. They'll do whatever it is with it. They're not, trying to hurt anybody's credit. They're actually trying to get people to, they're trying to get rid of their customers, like get people to that next point. And I will say their rates can be higher than the buy now, pay later, but they're working with a little bit of a higher risk buyer. So at any point, you can pay back the loan faster. So there's no like prepayment penalty or anything like that. So if you want to repay it or if you want to return it, whatever, then you don't have those expenses. But it is a little bit more expensive. But if they can help you build the credit, and hopefully they, that gets out of that. But yeah, I think this whole thing, I would love to like bookmark this and come back in 6 months or a year and see what happens with these, because there has to be some regulation around this. There just has to be.
Yeah, there has to be, and there will. And anytime that anybody, I think over the last 30 years, that anytime a lot of people lose a lot of money somewhere, depending on who's actually losing the money, particularly consumers. And I don't think in this case it's the consumers losing the money. I think in this case it's probably investors losing money. But hey, you don't actually lose money until you sell. So if we have a gigantic upturn sometime out there in the future, this could all be naught. And then you can be like, hey, Pat, remember the time you were like throwing stones at buy now, pay later? Well, guess what? It's like it's $1 trillion market. So that people are actually making money in. And I know you're not the big advocate of it, but I do totally, our credit system is broken. Okay. Yeah. The fact that I had almost no debt about a decade ago, and I had a terrible credit score, is just completely flabbergasting to me. And I think to a lot of other people who are in different situations. And if you haven't quote unquote established credit, so we have to change something, and, some credit for good behavior. Equifax, has the ability to, you can connect your bank account and prove that you pay your gas bill on time. And they might, increase it by a max of 50 points, but in a score of 800, I mean, who cares? I don't think that's the difference between, a point differential in what somebody will offer you. So yeah, I'd like to break some glass with buy now, pay later and crypto to get to where I think we all want to get holistically, which is a safe environment that is more equitable for everybody involved. So with that, so we've done mid-year update on crypto, buy now, pay later. Let's jump into the acronym of the week, BTFD. Tell us what this is. I need to know. I use BFD a lot. And since the 70s and 80s, people use it a lot less. But
Yeah.
I still use it. I like it. So what is BTFD?
So I can't use a swear word, so I'm just gonna use the sort of abbreviated version, but it's buy the effing dip.
There we go. That's so good. And by
So
the
this
way, we are not a kids show. I actually have the ticker that says there could be some dirty language coming up. So, but your kids might be watching.
they could.
And I don't have grandkids. I have kids too, but they could be watching you. So thank you. So,
I mean,
okay.
they've heard me say that word before.
I know, we've all done this.
Yes.
Gosh, I remember the first time I heard my mom say this when I was like 13. I was like, "Are you kidding?" And I said, "This is not how moms are supposed to talk." Okay. And he's like, "Well, what if your dad would say that?" And I said, I would tell him the same thing. It was shocking to me. But anyways, I'm sorry. This is your show. I'm just the freaking host.
No.
So okay.
So
This is if you don't know what buy the effing dip means, actually just go.
So
Explain away.
I'd love to get your take on this because, like I said, so this in particular, you could apply this to anything in the market.
Yeah.
But this in particular, I'm sort of referring to the dip in crypto right now. And because so many investors bailed in June, early June, it was like, just get out. I think there's like these maximalists that think that you got to just hold on to it for, the hodlers.
Hodlers.
That, think like
Hodlers
now,
or hodlers?
hodlers.
Okay.
That like now's the time to buy, right? Like now's the time to get more. And, so it's like, just buy the effing dip.
Yeah.
So I don't know. I'm curious what you think about that. And again, no investment advice, but like,
I told you where I am. Until there is some value underneath it, doesn't even have to be tangible. I just like intangible value. It scares me a little bit. And there's no government in the world that has any high degree of GDP that's going to allow this to go scot-free.
Mm-hmm.
And it's going to be regulated because out of criminals who might use this to do something, terrorists who might use it to do the money, tax cheaters who might use it to circumvent the system. It is going to be regulated. I 100% believe in the Western worlds it will be. I think in Latin America it won't be regulated as much. Their financial systems aren't regulated as much as ours. China's made it very clear that it's going to be hyper regulated. They already outlawed crypto mining in the country, and I think they all moved to Texas, by the way. So yeah, I mean, at that point, when it starts to get regulated, maybe it's a good thing, but without incremental value on top of it, does it actually have any value? I'm kind of on the other side. I'd rather put my money into high growth stocks that I can lose 80% on, not 90%. Right. So much safer investments. Much safer. That's just my own personal.
Yeah.
Talk to your broker or somebody who's Series 7 certified.
Yeah, I mean, I know a lot of people who've made a lot of money on crypto, and they would definitely, I think they're buying it now. I just feel like I watch it in terms of, for my job, but I don't keep close enough, like watch on it in terms of like, oh, it's going up. I'm not up in the middle of the night checking on what the price of crypto is.
Yeah.
And I wouldn't buy enough of it to benefit from a little uptick, it's just, but I just liked that acronym, to be honest.
Yeah, it was fun. Well, it's fun giving my accountant for 2021 my losses on crypto. He asked me specifically. I was like, yes, I have losses
I have
on
crypto losses.
crypto
Well,
losses.
that's another interesting thing is that now there are like all these wealth management platforms, all these RIAs are having to figure out all of these new tax implications and tax laws around it. It's the, things are just really changing, and like having to figure out how to even classify that. It's a lot of, not to mention that like crypto Twitter is
Yeah,
just crypto
totally.
crypto
Hey,
Twitter.
let's move this along here. The show does not stop when the show stops,
The
or the
show
work doesn't stop when the show stops. What's going on? What's coming up? Part two.
Part two, let's talk about what's happening in retail. There's a lot of stuff happening in retail. There's a lot of stuff happening. I mean, we have a lot more to talk about in fintech and financial services. We have a lot to talk about in AI, and we have a lot to talk about in vertical cloud. There's so much going on. I feel like we have like a big catch up we have to do.
We do. We just need to get on schedule and go from there. And I'm all game for not having to do it on a Friday. Although, FTF was easy. It came right off. Then we expanded it to retail. And I think we need to give some of these brands some time on the show too, like IBM, who has a very relevant and credible financial cloud that is backed by people like Bank of America. And I think they have 52 ISVs that are plugged into that network as well. And I'm expecting more retail clouds as well, and more financial clouds. I think we need to be talking about that. And you and I had talked about this. Maybe we talk a little bit more about the B2B side. Whenever we're talking about crypto, I get that feedback sometimes on, hey, consumer's great, but it's in the winter right now. Let's talk about the blockchain. Let's talk about technologies, financial technologies, and retail technologies that are outside the consumer space.
Absolutely. I think there's so much in the B2B space that is so ripe right now, especially because everything on the consumer side is sort of shrinking and having to pull back in so many different ways that I think there's just so much more happening there. And it's also where a lot of investment dollars are going. When like if in the startup space, so there's all the enterprise side, which has always been there and they're always innovating, but there is kind of a little bit of a digital transformation that's happening there, which is interesting. But then on, kind of more of the startup space, that's where the investments are going, is in that B2B space.
Yeah, no, it sounds good. So, hey, here we are. We made it.
Yay.
Right? Our 18th show. Had I not, canceled a few, we'd probably be on episode 25 by now. And maybe if you hadn't canceled a few, we'd be on 27. But
maybe we'll make it to 50 by the end of the year.
No, we will. We're gonna be consistent, and we're gonna bring it like we always do, with maybe a different set or a more comprehensive set of content. So everybody out there, thanks so much for tuning in. And if you like what you heard, hit that subscribe button. If you want to give us feedback, the good, the bad, and the ugly, you can find Mel and I on Twitter, where I spend way too much time on that platform. Mel spends a little bit time on there, and I think she'll be on there even a lot more now that the kids are in school and she has more time. I mean, all my kids, I have 2 kids that are out of the nest 100%. Well, little checks here and there, and then one that's halfway in college. Life is a lot easier.
Life is easy. Yeah.
But thanks for
Look at my Twitter. You see a lot of baseball right now.
Love it. I love it. Athletes in the family, good athletes in the family. So it's great stuff. Thanks for tuning in.